Hello and welcome back. Today we're dissecting the latest financial report from a giant in the Indian healthcare space, Apollo Hospitals Enterprise Limited. They're a household name, operating hospitals, pharmacies, clinics, and a growing digital health platform.
That's right. Apollo is one of Asia's largest integrated healthcare organizations, with a significant presence across the entire healthcare ecosystem, from primary care to complex quaternary care. They also have key subsidiaries like Apollo Health and Lifestyle Limited, or AHLL, focusing on clinics and diagnostics, and Apollo Health Co., which is spearheading their pharmacy distribution and digital health initiatives.
So let's get into it. We're looking at their financial results for the fourth quarter and the full financial year ended March 31st, 2025. The Board of Directors approved these results on May 30th, 2025. We'll be covering both the consolidated and standalone figures today.
Sounds good. There's a lot to unpack here.
Let's start with the consolidated numbers for the fourth quarter of FY25. How did Apollo Hospitals fare in terms of revenue?
All right, for Q4 FY25, on a consolidated basis, Apollo's revenue from operations stood at 5,592.2 crore rupees. Comparing this year over year, that's a healthy 13% increase from the 4,943.9 crore rupees they reported in Q4 FY24. Now, looking at it quarter over quarter, revenue saw a slight increase from 5,526.9 crore rupees in Q3 FY25. So, steady sequential growth there.
Okay, a good jump year over year and some modest growth sequentially on the revenue front. What about their operational profitability? How's the EBITDA looking for that consolidated entity in Q4?
The consolidated EBITDA for Q4 FY25 came in at 769.8 crore rupees. Year over year, that's a strong 20% growth from 640.5 crore rupees in Q4 FY24. Quarter over quarter, the EBITDA was 783.1 crore rupees in Q3 FY25. So there's a slight sequential moderation in Q4. We should note the investor presentation highlights the Q4 EBITDA includes costs related to the Apollo 24/7 business, including ESOP charges.
Right, and profit before tax on PBT for the consolidated business in Q4?
Consolidated PBT for Q4 FY25 was 515.5 crore rupees. This is a significant year-over-year jump of nearly 40% from 368.2 crore rupees in Q4 FY24. Quarter over quarter, it's slightly down from 536.2 crore rupees in Q3 FY25.
A very strong year-over-year PBT growth. And the bottom line, profit after tax or PAT for consolidated Q4?
The consolidated PAT attributable to owners for Q4 FY25 stood at 389.6 crore rupees. Year over year, that's an impressive 54% increase from 253.8 crore rupees in Q4 FY24. That's quite a leap. Quarter over quarter, PAT is up from 372.3 crore rupees in Q3 FY25.
Wow, a 54% year-over-year growth in PAT is indeed significant. How does this translate to earnings per share or EPS?
The consolidated basic EPS for Q4 FY25 was 27.10 rupees. Year over year, this is up from 17.65 rupees in Q4 FY24, and quarter over quarter, it's an increase from 25.89 rupees in Q3 FY25. Again, these quarterly EPS figures are not annualized.
Any significant other income in the consolidated Q4 results?
Yes, other income for Q4 FY25 on a consolidated basis was 61.1 crore rupees. Year over year, this is more than double the 28.1 crore rupees from Q4 FY24. Quarter over quarter, it's slightly down from 63.8 crore rupees in Q3 FY25. This jump in other income year over year certainly helped the PBT and PAT figures.
Okay, that covers the consolidated Q4. Now let's switch to the standalone financial results for Apollo Hospitals for Q4 FY25. How does the picture look here, starting with revenue?
For the standalone entity, revenue from operations in Q4 FY25 was 2,075.3 crore rupees. Year over year, this is up by 9.5% from 1,894.6 crore rupees in Q4 FY24. Quarter over quarter, revenue saw a marginal increase from 2,054.8 crore rupees in Q3 FY25.
And standalone EBITDA for Q4?
Standalone EBITDA for Q4 FY25 was 521.3 crore rupees. Year over year, this is a good 15.7% increase from 450.4 crore rupees in Q4 FY24. Quarter over quarter, EBITDA also grew, up from 511.8 crore rupees in Q3 FY25.
What about standalone PBT for the quarter?
Standalone PBT for Q4 FY25 stood at 420 crore rupees. Year over year, that's a solid 34.4% increase from 312.4 crore rupees in Q4 FY24. However, quarter over quarter, PBT saw a decrease from 449.3 crore rupees in Q3 FY25.
Interesting. Quarter over quarter dip there in PBT, despite revenue and EBITDA being up. What about standalone PAT?
Standalone PAT for Q4 FY25 was 333.4 crore rupees. Year over year, this is up by 39.6% from 238.8 crore rupees in Q4 FY24. But similar to PBT, quarter over quarter, PAT also declined from 341.6 crore rupees in Q3 FY25.
And the standalone EPS for Q4?
The standalone basic EPS for Q4 FY25 was 23.18 rupees. Year over year, this is up from 16.61 rupees in Q4 FY24. Quarter over quarter, it's down from 23.76 rupees in Q3 FY25. Again, these are not annualized.
Any notable other income on the standalone side for Q4?
Yes, standalone other income was 91.6 crore rupees in Q4 FY25. Year over year, this nearly doubled from 46 crore rupees in Q4 FY24. Quarter over quarter, however, it was down from 107.9 crore rupees in Q3 FY25. The year-over-year increase in other income definitely boosted the standalone PBT and PAT.
Thanks for that quarterly breakdown. Now let's zoom out and look at the full financial year, FY25 performance, starting with consolidated results for FY25.
For the full year FY25, consolidated revenue from operations reached 21,794 crore rupees. That's a 14% increase year over year from 19,059.2 crore rupees in FY24. Consolidated EBITDA for FY25 was 3,021.9 crore rupees, up by a strong 26% year over year from 2,390.7 crore rupees. Consolidated PBT for FY25 stood at 2,039.1 crore rupees, a significant 47.7% increase year over year from 1,380.5 crore rupees. And consolidated PAT attributable to owners for FY25 was 1,445.9 crore rupees. This is a massive 61% jump year over year from 898.6 crore rupees in FY24. Quite the performance for the full year. The consolidated basic EPS for FY25 was 100.56 rupees, up from 62.50 rupees in FY24.
That's a very strong full-year consolidated performance, especially that 61% PAT growth. Now what about the standalone full-year FY25 numbers?
For the standalone entity, full-year FY25 revenue from operations was 8,202.1 crore rupees, up by 12.8% year over year from 7,273.8 crore rupees in FY24. Standalone EBITDA for FY25 was 2,044.2 crore rupees, a 13.7% increase year-over-year from 1,797.5 crore rupees. Standalone PBT for FY25 stood at 1,688.5 crore rupees, up 27% year-over-year from 1,328.6 crore rupees. And standalone PAT for FY25 was 1,296.3 crore rupees, which is a 28.3% increase year-over-year from 1,010.5 crore rupees in FY24. The standalone basic EPS for FY25 was 90.15 rupees, up from 70.28 rupees in FY24.
So, strong growth across the board for the full year for both consolidated and standalone entities, though the consolidated growth, especially in PAT, seems more pronounced.
Absolutely. The consolidated figures benefit from the performance of all subsidiaries, including the rapidly growing HealthCo and AHLL segments.
Let's talk about margins. What do these numbers tell us about Apollo's profitability for Q4 and the full year?
Okay, for Q4 FY25 consolidated, the EBITDA margin was about 13.8%. This is an improvement from around 13.0% in Q4 FY24. The PAT margin for Q4 FY25 was around 7%. For the full year FY25 consolidated, the EBITDA margin improved to 13.9% from 12.5% in FY24. The PAT margin for FY25 was around 6.6%, up from 4.7% in FY24. So definitely margin expansion at the consolidated level. On the standalone side, for Q4 FY25, the EBITDA margin was a strong 25.1%, up from 23.8% in Q4 FY24. The PAT margin was about 16.1%. For the full year FY25 standalone, the EBITDA margin was around 24.9%, fairly consistent with 24.7% in FY24. The PAT margin was about 15.8%, slightly up from 13.9% in FY24. So the healthcare services, that is the standalone business, operates at much higher EBITDA margins compared to the consolidated entity, which includes the pharmacy distribution and digital businesses that typically have lower margins but are scaling up.
Were there any significant exceptional items reported in FY25 that we should be aware of?
Yes, the consolidated financials for the year ended March 31st, 2025 do mention an exceptional item. Note 3 to the financial results on page 20 of the PDF details that during the year, Apollo Hospitals International Limited or AHIL, a subsidiary, acquired an additional 50% stake in Amrish Oncology Services Private Limited or AOSPL, making AOSPL a wholly owned subsidiary. The acquisition date fair value of the existing equity interest in AOSPL compared to its carrying amount resulted in a gain of 1.9 crore rupees, which has been included under exceptional items. It's a relatively small amount in the grand scheme of things. Good to note,
A small gain, but an exceptional item nonetheless. What can we glean from the balance sheet? Any major changes in assets or liabilities?
looking at the consolidated balance sheet as of March 31st, 2025, total equity attributable to owners stood at 8,212.3 crore rupees, up from 6,935.4 crore rupees the previous year. Non-controlling interests also increased. Total assets were 20,657.4 crore rupees, up from 16,753.1 crore rupees. The investor presentation also gives a debt snapshot. Consolidated gross debt is 2,830 crore rupees and consolidated net debt is negative 109 crore rupees, meaning they have more cash and equivalents than debt at the consolidated level, which is a strong position. For standalone balance sheet, total equity was 8,734.2 crore rupees, up from 7,710.9 crore rupees. Total assets stood at 13,372.3 crore rupees, up from 12,405.2 crore rupees. The standalone borrowings, that is non-current plus current, were around 3,850.5 crore rupees, down from about 4,950.5 crore rupees, indicating some deleveraging at the standalone level.
A net debt negative position at the consolidated level is certainly a highlight. How about the cash flow situation for FY25 and did they announce any dividends?
Yes, we have the consolidated cash flow statement. For FY25, net cash generated from operating activities was 2,136.4 crore rupees, up from 1,920.2 crore rupees in FY24. Net cash used in investing activities was quite significant at negative 3,380.6 crore rupees, much higher than the negative 1,537.2 crore rupees in FY24. This reflects increased investments, likely in expansion and acquisitions. Net cash from financing activities was 1,316.8 crore rupees compared to negative 311.1 crore rupees last year, indicating net inflow from financing possibly related to the healthco investments. The standalone cash flow shows net cash from operating activities at 1,741.9 crore rupees, up from 1,191.4 crore rupees in FY24. Net cash used in investing activities was negative 1,045.7 crore rupees. Net cash used in financing activities was negative 739.1 crore rupees. Regarding dividends, the outcome letter mentions that the board recommended a final dividend of 10 rupees per equity share, that is 200% for FY25. This is in addition to an interim dividend of 9 rupees per share declared earlier. So the total dividend for FY25 amounts to 19 rupees per equity share, which is 380% of the face value. The record date for the final dividend is August 19, 2025, and payment will be on or before September 10, 2025.
So healthy operating cash flows, significant investment activity, and a good dividend payout for shareholders. Now this is always a crucial part. How did Apollo's different business segments perform in Q4 and for the full year FY25? Let's look at the consolidated segment performance.
This is where it gets really interesting. Apollo reports primarily under three main segments in its investor presentation: Healthcare Services, Apollo HealthCo, which includes offline pharmacy distribution and online pharmacy and 24/7, and AHLL, that is Diagnostics and Retail Health. The financial segment reporting uses slightly different naming: Healthcare Services, Retail Health and Diagnostics, and Digital Health and Pharmacy Distribution. Let's break it down based on the investor presentation data, which gives us a good operational view. Healthcare Services, that is hospitals. For Q4 FY25, revenue was 2,821.9 crore rupees, a 10% year-over-year growth. EBITDA grew 16% year-over-year to 686.2 crore rupees with an EBITDA margin of 24.3%. PAT for this segment was 385.1 crore rupees, up 37% year-over-year. For the full year FY25, revenue hit 11,147.5 crore rupees, up 13%. EBITDA was 2,700.5 crore rupees, up 15%, with a margin of 24.2%. PAT was 1,426 crore rupees, a 25% increase. So, the core hospital business is showing steady growth and strong profitability. Apollo HealthCo total. For Q4 FY25, total HealthCo revenue was 2,376.3 crore rupees, a 17% year-over-year growth. EBITDA turned positive at 36.3 crore rupees compared to 11.7 crore rupees in Q4 FY24. PAT for HealthCo was 8.8 crore rupees, a significant turnaround from a loss of 17.7 crore rupees in Q4 FY24. Within HealthCo for Q4, offline PD or PD, revenue was 2,084.4 crore rupees, up 17% year-over-year. EBITDA was 161.6 crore rupees, up 21%. Online PD and 24/7, revenue 291.9 crore rupees, up 22% year-over-year. However, this segment reported an EBITDA loss of 125.3 crore rupees, slightly wider than the loss of 121.9 crore rupees in Q4 FY24. For the full year FY25, total HealthCo revenue was 9,093 crore rupees, rupees, up 16%. EBITDA was positive at 167.6 crore rupees compared to a loss of 81.7 crore rupees in FY24. PAT also turned positive at 46.9 crore rupees from a loss of 195.7 crore rupees. That's a major swing. Within Healthco for FY25, offline PD revenue 8,014.3 crore rupees, up 16%. EBITDA 612.4 crore rupees, up 17%. Online PD and 24/7 revenue 1,078.7 crore rupees, up 20%. EBITDA loss of 444.9 crore rupees, but this is an improvement from a loss of 604.7 crore rupees in FY24, showing the path to profitability is progressing for the digital arm.
That's a significant turnaround for Healthco overall, especially driven by the offline pharmacy strength and narrowing losses in the digital segment. AHLL, that is Diagnostics and Retail Health, for Q4 FY25, revenue was 394 crore rupees, up 11% year-over-year. EBITDA grew 32% to 47.2 crore rupees, with margins improving to 12%. The PAT loss narrowed to 4.3 crore rupees from a loss of 8.7 crore rupees in Q4 FY24. For the full year FY25, revenue was 1,553.5 crore rupees, up 14%. EBITDA grew 32% to 153.8 crore rupees, with margins at 9.9%. The PAT loss significantly narrowed to 27 crore rupees from 50.8 crore rupees in FY24. So AHL is also showing good revenue growth, strong EBITDA improvement, and is moving closer to profitability.
Exactly. The segment performance clearly shows that while healthcare services remains the bedrock with high margins, both Healthco and AHL are scaling up, improving their EBITDA, and Healthco even turned PAT positive for the year. The digital part of Healthco is still incurring losses, but those are reducing.
So, summarizing the overall performance, strong year-over-year growth for both Q4 and the full year FY25 on consolidated and standalone fronts. What were the key drivers?
The investor presentation highlights that for healthcare services in Q4, inpatient volumes grew by 4%, and there was a price and case mix benefit of 6%. They also focused on higher growth in CONGO-T specialties. Occupancy for Q4 FY25 was 67% versus 65% in Q4 FY24. For Apollo Healthco, the offline pharmacy business saw a 12.6% year-over-year growth in offline transactions in Q4. The digital platform, that is Apollo 24/7, saw its gross merchandise value, or GMV, grew by 11% year-over-year in Q4 FY25 to 795.4 crore rupees. Registered users are now over 40 million. AHL's growth was driven by network maturity across key segments, and the wellness segment and diagnostics grew its volume by 18% in FY25.
It sounds like a multi-pronged growth strategy playing out. Were there any other significant notes, announcements, or strategic moves mentioned in the reports?
Oh yes, quite a few. The investor presentation highlights several clinical updates, including crossing 25,000 cumulative transplants. A major point is the Apollo Healthco Advent investment. AHL raised 2,475 crore rupees equity capital from Advent International. They're also proposing an integration with KeyMed Private Limited, a large wholesale pharma distributor, in a phased manner, which is expected to be EPS accretive from year one and create a leading integrated pharmacy distribution business. This is a very big strategic move. Expansion plans are significant. They've announced a major expansion in Bengaluru, specifically Sarjapur, with 700 new beds in 2 stages. That is, 200 existing leased, 500 greenfield. Total bed strength in Bengaluru will go to around 1,500 beds. In Hyderabad, brownfield expansion of 160 beds. Total strength will be around 1,400 beds. Overall, Apollo commits to adding over 4,300 beds over 3 to 4 years starting FY26, with a total capital outlay of over 8,000 crore rupees. The outcome letter specifically mentions the purchase of a land parcel in Sarjapur for a 500-bed hospital that'll cost 944 crore rupees, and acquisition of an existing 200-bed hospital asset nearby that'll cost 285 crore rupees. From the notes to consolidated financials, there's an emphasis of matter which we'll discuss with the auditor's report. Note 3 details the AOSPL acquisition and the small exceptional gain. Note 4 mentions the proposed merger of AOSPL into AHIL. Note 5 and 6 detail the Rasmali investment in AHL and the Searchlight BTA by AHL.
Massive expansion plans and a very strategic move with KeyMed. These will be key to watch. Now for a critical section, the auditor's report. What did Deloitte Haskins & Sells LLP have to say about both the standalone and consolidated financials?
Okay, for the standalone financial results, the auditors issued an unmodified opinion. This means they believe the standalone financial statements give a true and fair view and are free from material misstatement. There's an other matters paragraph which is standard, clarifying that the Q4 figures are derived as a balance between the audited full-year figures and the reviewed 9-month figures. So no major red flags on the standalone audit.
That's good news for the standalone part. What about the consolidated financial results?
For the consolidated financial results, the auditors also issued an unmodified opinion. However, they included an emphasis of matter paragraph. This draws attention to Note 11 of the consolidated financial results. Note 11 pertains to legal proceedings initiated against Imperial Hospital and Research Centre Limited, a subsidiary, by the Government of Karnataka regarding allotment of land. The management, based on an external legal opinion, believes the subsidiary has adequate grounds to demonstrate compliance and that a matter will be settled in its favor. The auditors state their opinion is not modified in respect of this matter. So, while not a qualification, it's something to be aware of, an ongoing legal matter.
So, an emphasis of matter is like a heads up from the auditors on a specific issue that's important for users to understand, even if the overall financials are considered true and fair?
Precisely. They also have an other matters section in the consolidated report. Firstly, it reiterates that the Q4 figures are balancing figures. Secondly, and importantly, it states that the financial statements of 30 subsidiaries reflecting total assets of 3,102.7 crore rupees and significant revenues and the group's share of profit or loss of 6 associates and 2 joint ventures were audited by other auditors, whose reports were furnished to them. Their opinion on the consolidated results, insofar as it relates to these entities, is based solely on the reports of these other auditors. This is a common practice for large complex groups. They also mention that the financials of one subsidiary were unaudited, but its financial impact is stated to be not material. Finally, the company also provided a declaration stating that the auditors have issued an audit report with an unmodified opinion on both standalone and consolidated financial results for the year ended March 31st, 2025.
Okay, so the main thing to note from the consolidated audit is the emphasis of matter regarding Imperial Hospital. No qualifications, which is positive. Based on all this, what's the outlook for Apollo Hospitals and what are the potential risks?
The outlook appears quite positive, driven by strong performance in the core hospital business and significant scale-up and profitability improvements in HealthCo and AHL. The massive expansion plans for over 4,300 beds indicate strong confidence in future growth. The strategic investment by Advent and the proposed KeyMed integration for HealthCo could be transformative for the pharmacy and digital health business, aiming for revenues of around 25,000 crore rupees in 3 years, with 7 to 8% operating margins for the combined entity. Those are ambitious targets. Key drivers will be continued growth in patient volumes and ARPOB in hospitals, successful execution of the aggressive hospital expansion plan, scale-up of the Apollo 24/7 digital platform and its path to profitability, synergies from the Keimed integration, growth in diagnostics and retail health via AHL. Potential risks include execution risk associated with large-scale greenfield and brownfield expansions, integration risks with Keimed, increasing competition in the healthcare and pharmacy space, regulatory changes in the healthcare sector, the ongoing legal matter highlighted in the emphasis of matter for Imperial Hospital, though management is confident, sustaining profitability in the digital health segment while scaling.
And of course, the standard disclaimer.
Yes, absolutely. We advise all investors to check with certified financial experts before making any investment decisions. This discussion is for informational purposes only.
So, to wrap up our discussion on Apollo Hospitals Q4 and FY25 earnings, what are the main takeaways?
Apollo Hospitals has delivered a very strong financial performance in FY25, with significant growth in revenue and even more impressive growth in profitability, especially at the consolidated level. The core hospital business remains robust with healthy margins. The healthcare segment, particularly the offline pharmacy business, is a major growth engine and has turned profitable for the year, with the digital arm also showing improved metrics. AHLL is also on a good trajectory. The aggressive expansion plans, including the new beds and the strategic Keimed integration, signal a very ambitious growth path for the next few years. The balance sheet looks healthy, especially with a net cash position at the consolidated level. The auditor's report is largely clean, with an unmodified opinion for both standalone and consolidated, though the emphasis of matter on the Imperial Hospital case is a point to monitor.
It certainly sounds like Apollo Hospitals is positioning itself for significant future growth across all its verticals. Lots to keep an eye on. That's all the time we have for today. Thanks for joining us.
Thanks for having me.
We'll catch you on the next episode. Don't forget to subscribe.